a lot of the domestic money or the domestic household savings has been moving into the equity markets, and that is something which is supporting every decline in the market. Earnings continuing to be very strong. Fundamentals of our economy, I would say they are the most strongest compared to any other emerging country. Even we are doing better than developed markets. Don't paint one entire market cap with the same brush. There are companies in the small cap which are attractively priced. There are companies in small cap which are expensive. So I would say I would look at more of a bottoms up at the companies to see if the valuations are expensive or not.
Hello and welcome to another episode of Fund Manager Interview with PMS Bazaar. In today's session, we have somebody special from Quest Investment Advisor. He is the CIO and Portfolio Manager. We have Mr. Aniruddha Sarkar of experience in capital markets. Aniruddha Sarkar has a proven track record of managing investment across PMS, AIF and advisory platforms. As the CIO and the Portfolio Manager of Quest Investment Advisors since February 2020, he leverages his expertise to identify promising sectors and themes, often capturing them early on in their life cycle. Before joining Quest, Aniruddha Sarkar spent 11 years at IIFL Group of Companies. At IIFL AMC, he was the portfolio manager of IIFL Multi-Cap PMS from its inception in 2014. He holds a bachelor degree in commerce and a master's degree in business administration and finance. Welcome, sir.
Thank you.
We'll start with the market first because that's what everybody wants to know. So in that regard, our markets have been volatile and they've been on a spring, right? So just when we thought that they won't make a comeback, they touched an all-time high of 25,000, right? So so it doesn't stop to surprise us. What do you think? Do you think this rally will continue, or considering how Q1 results were and how Q2 is expected and all that, what is your view about the market in general?
Answering this question on the market view, I would say that, I keep saying one thing, that everybody has been expecting the markets to fall. But one thing I inform them that when everyone expects something, that is not going to happen. And that's the reason we are not seeing a correction in the market. With regard to the markets making new highs, I would say one thing which has really changed for the last 4-5 years is that a lot of the domestic money or the domestic household savings has been moving into the equity markets. And that is something which is supporting every decline in the market. Every dip in the market is getting bought. Thanks to domestic investors, both the retail and HNI investors, I would say FIs are not deciding the direction of the market as of now. Having said that, it's not only about the liquidity, it's also about earnings continuing to be very strong. Fundamentals of our economy, I would say they are the most strongest compared to any other emerging country. Even we are doing better than developed markets. So I think our macro fundamentals are supporting, which is getting reflected in the corporate earnings, which is getting reflected in the optimism of domestic investors. So I would say they are all going in sync, which is keeping the markets as it is.
All high. So there's no surprise there. But, we never know about the market. Right. So on to the next question. With regard to Quest Investment Advisors portfolio, how are you invested? Are your money fully deployed, or do you have some cash allocation left? What are your reasons, if you can explain?
On an average, I keep around 4 to 5% cash in my portfolio at any point of time. That is also the cash level which I have in my portfolio at this point of time. There are times when I take aggressive cash calls going up to 10-12% cash, but that's not very often. Whenever there's an event or there's a market risk, that is the time I would want to keep a higher cash level, which is not the case at this point of time. Around elections, I had around 10% cash, which as the results were announced, I got it deployed in the market. As of now, 4-5% is the average cash in the portfolio.
Okay. So you're big on sector rotation. So can you tell to investors in general, like how to time entry or exit into into the sectors, and what should investors do, like a basic checklist?
See, I often get this question from investors that, sector rotation, it sounds very good, but exactly how do you do sector rotation? I answer it saying that there is no magic formula. To be honest, you have to be connected to the market. We evaluate 400 plus companies. We interact with managements of different companies. We interact with industry experts. On an ongoing basis, all this interaction is what gives you optimism or pessimism into different sectors. Because if you're continuously going to meet the same management over every quarter, every month, that's the time you get a sense whether the business is going through an upcycle or the business is going through a down cycle. That is one part of it. The second part of it is looking at the valuations. If valuations are going to be very rich, definitely that needs to be justified with the earnings. if earnings are not going to support your valuations, that is a big kind of a call for me to get out of those sectors. There are sectors I've been holding for a long time, done very well. I continue to hold just because earnings are supporting the valuations. So valuations along with interaction with companies and industry experts gives you an outlook of being bullish or bearish on a industry.
And that kind of leads to an entry and
Yeah,
exit
absolutely.
from the
That
stock.
leads you to take a call on getting overweight or underweight on that particular industry.
Right, right. And on that aspect, right? So with respect to when you're selecting the stock, is it sector first and then stock, or vice versa? Like, what is your strategy here?
Excellent question. I'll answer that by saying that both goes hand in hand. You can't pick up a sector and then decide I want to buy a industry, I want to buy a company, purely because that sector outlook comes from interaction with those companies. So when I'm interacting with those companies, that is the time you identify that this company is expected to do well. Now, when you identify multiple companies in one industry which are expected to do well, that is the time you'll understand that this sector is going to do well. So it is going to be a hand in hand of both sector selection and company selection within that industry.
Okay, with respect to your portfolio now you have a couple of stocks, like I'm just naming an example here, Zomato and Trent, right? So they've run up quite a bit, and in some select sectors too, there are some stocks that have rallied so much. Like, how do you see any room for further re-rating here? How do you evaluate?
As I mentioned, in this very important is that is the earnings justifying the valuations. Now something like a Tata Trent, I'll give an example. Where it quotes today, it is roughly at around 2 to 2.5 times price to earnings growth, which is called the PEG ratio. When we entered the company, it was slightly more expensive on the PEG because that time the earnings was not so much, which means that if your earnings are growing higher, your multiples can be justified. So as long as I don't see a earnings growth concern, whether in Trend, Zomato or any other company, I would not be concerned about exiting. So it's all about earnings supporting the valuation, which I don't see being a concern in both these companies at this point.
Okay, so considering how small caps and mid caps have been behaving, recently or for the past few years, what is your view here? We can see that some points or some pockets there's some high valuation, some they don't. And how do you justify this? How do you enter or exit into such segments?
See, over the last 6 months, a lot of debate has been happening whether small caps are expensive or not, whether it's good to be into the large caps. I would say that, and this is something I've been telling investors over the years, don't paint one entire market cap with the same brush. There are companies in the small cap which are attractively priced. There are companies in small cap which are expensive. There are companies in the large cap which are attractively priced. There are companies in large cap which are expensive. So I would say I would look at more of a bottoms up at the companies to see if the valuations are expensive or not. Where it stands today, I am slightly overweight on the small caps, very contrarian to what the market is saying. But I would say that that is where over the next 36 months your highest earnings growth is going to come from. Right. If I talk about as a percentage of the large caps, if large caps give you around 14% earnings growth for the next 24 months, over the next 24 months, small caps, which I have in my portfolio, will give roughly around 28 to 30% earnings growth.
Interesting.
Which justifies the multiples at which they are quoting.
Okay, got it. Now a bit more on the sectoral side. So you're slightly overweight on certain sectors. We have auto, for instance, but on the other hand, there are a lot of news that has recently come up saying that auto sector is, kind of facing a slowdown. We wouldn't term it slowdown, but then there's a weakness that they're expecting, right? So what is your view here? I mean, you're still overweight and you're still confident on the sector? On the auto side, what I own as of today, I don't own any OEM. What I own is auto ancillary. Now within auto ancillary, the companies where we are exposed to, they are increasing the wallet share in the wallet of the OEMs. Now that is where I'm betting on, that these auto ancillary companies are going to get increased business from the same customers which are there in the market. Now good part is all these auto ancillary companies are engine agnostic, whether it's IC engines or EV, they are supplying to companies which are catering to both of these engines. The third company which I have in autos is the bikes and the scooters, and that is something growing faster than the cars. Right. Now I've been very bullish on the two-wheeler space, and what I own is the biggest, or not the biggest, the fastest growing two-wheeler company in that space. So where within even a sector which looks optically that it's a difficult sector to be in, within that also there are very high growth pockets, and that is where I'm betting on. Okay, and I'm assuming the same applies to your consumer services as well. Absolutely, right? Like we have been hearing on the consumer side that there's a lot of pain on the rural consumption. I have been away from the rural consumption for the last 18 months. Not a single stock in my portfolio is exposed to rural consumption.
I have been betting on the urban consumption. That is one part of the economy which is very, I would say, very resilient with regard to demand and income growth. And whatever is happening in the rest of the world, whatever is happening in the rural side, that part of economy is not affected.
Okay, that's very interesting. Now, on one hand, where you're seeing overweight on auto and consumer services, on the other, this is something that everybody has an allocation to, which is banks and other financial services. And the index is given nearly 35% return, whereas your allocation seems to be coming down. And what is the logic behind here?
So banks historically in the benchmark index has been around 30% weightage, but I have been over the last 4.5 years practically always been underweight on the banks. Out of the 4.5 years, barring 1 year, the rest of the time being underweight on the banks has helped. On the contrary, I have been more bullish on the non-bank financial services. Now, when I say non-bank financials, it is about your asset management company, wealth management, insurance, the housing finance companies, and that is where I believe the growth is coming from. Even within the banks, I have been underweight on the private banks and more bullish on the PSU banks. As it stands today, I think private banks valuations have corrected a lot, and that is where I believe that downside looks less, good room for upside. If we see the RBI also taking some measures on not being so strict with regard to the lending growth, I think you will see good upside on the banking sector also.
Mostly on the non-bank financial service. Okay, so since we've been discussing about sectors, what are your favorite sectors or themes that you're betting on in the near term or the medium term?
The top sector which I have allocation in my portfolio at this point of time is your urban and semi-urban consumption. As I mentioned, that is one part of the economy which has been doing very well. Within that, the sub-sectors within that where I'm betting on, one is the real estate and ancillary. I've been a bit underweight on the real estate of late. I was bullish on the real estate for a long time. Second sub-sector is your auto and auto-ag. The third is your consumer discretionary, which includes your eating out, going out to the malls and everything. That is something we all love to do. And the last part is your hospitality, which is your hotels, because hotels has seen a massive, I would say, upside cycle, and that is where the cash flows are also coming from. The second sector or the sectoral theme I'm bullish on is the whole industrials and capex.
Right.
That is where a lot of private and public capex is happening, and I would say that it's not 1 year story, it's a multi-year story. Lot of private capex is going to happen. All this while it was all about the public capex which made the infrastructure. Now it is the job of the private sector to take charge, and that is where I would say a lot of job creation will also happen. The third area, as I mentioned, is on the BFSI, which is your banks and financials. More bullish on the non-bank financials, which includes your asset management, housing finance, insurance and wealth management companies.
Right. Since we are talking about sectoral bets, I was just wondering, because you mentioned industrials is a multi-year story, and there are so many news that capex cycle is just now picked up. And what are your views here? I mean, there are mixed reviews, honestly. Some say that that is yet to pick up. And what are your thoughts?
So private capex has not picked up in a big way, which is a fact, all of us know. But I would say a large part of the private capex was actually waiting for the elections to get over. Public capex has been the major driver all these years. Typically, private capex happens when the capacity utilization crosses 75%. That's a kind of a ballpark number. Once it crosses 75%, that's the time when private capex picks up. Where Indian capacities are running anywhere between 70 to 80. So I think we are in the right time right now wherein the private capex can actually pick up, and this is actually happening across industries.
Right.
So the plans are made, the lines of the credit are already there, and the good part is in this capex cycle you will see balance sheets not getting stretched, because corporate India's balance sheet is at the best you have seen in the last 10-20 years.
Right.
So leverage is not a concern, cash flows are there, balance sheets are very strong on their own cash flows, and I think we should be seeing a good capex cycle over the next 4 to 5 years.
Perhaps this rate cut by US Fed and probably RBI will also follow suit, and that can also help in this.
Yes, absolutely. I think the RBI has done an excellent job with regard to the interest rate management. We increased our rates much less than what the US Fed did.
Correct.
I don't expect the RBI to cut rates drastically like the US Fed in a big hurry. It will happen, but over time. And that also, I would say, gives your impetus for the corporates to borrow and do capex. That if the rate cycle is going to turn, definitely it's going to be a win-win for all.
Yeah, jolly good show.
Absolutely.
So we've covered markets, sectors, and we'll talk a little bit more about the PMS of Quest. your funds have delivered nearly 50% in this 1 year, and even in 5-year time frame, I think both your funds have delivered 20-25% return roughly, right? So could you tell me what has helped here, and what would be the focus area in this?
See, with regard to the portfolio, I would say consistency has always been my key focus area. That portfolio should be very consistent with regard to giving the returns. As you mentioned, the last 1 year has been an exceptionally good year. You don't get such good years every year, but I would say if I see the last 4 years, 5 years, I think there has been a bit of a consistency with regard to the returns. What I would attribute that would be purely about being slightly more active with regard to selecting the sectors. Second is selecting the market caps also. Which market cap you are bullish on, which market cap you want to go underweight on. The third thing which is there is about, I would say, picking up the right companies at the right valuation. So it is about sectors, about market caps, and then picking up the right companies within those sectors. It's an ongoing process, and I would say one thing which I keep an eye on is to avoid making mistakes. If you make one accident in your portfolio, it takes the good work of 4 or 5 good investments. So thankfully, there has been no accidents in the portfolio, and that has helped to generate the returns.
Right, that's great actually. But whenever we speak about entry and there's always a discussion on exit, I'm sure you would have explained this already. But if you can, in a few words, explain as to how your exit works, that also could help.
So both my entry and exit, they don't happen at one shot.
Right.
Typically, I would gradually build up my positions. Same for exit. Gradually, the position is exited or decreased. Now, your reasons for exit could be multiple. One reason for exit could be your valuation objective has been reached. Second would be that there is some external factors which have changed your whole investment thesis. And the third could be that you don't see much upside in the company where you have entered, and there's a better alternative to replace that with. Right. So these 3 things will basically decide your exits from the portfolio companies.
Okay, and last question. So you've recently launched one AIF as well. Now, if we look at the allocation, it looks very similar to your PMS. Not exactly, but to an extent, there's some similarity or rather overlap, right? So how is this AIF product is different? Number one, and number two, who would be the ideal investors for this product?
See, AIF and PMS, always this debate has been there, like, which one versus what. But I would say more and more I'm seeing HNIs wanting to move towards an AIF platform because of ease of operations. There is no hassle with regard to the taxation at the end of the year. So that has become a preferred vehicle for HNI. And that's the reason we have launched the second series of our Quest Smart Alpha Sector Rotation Series 2. Series 1 we had launched in May 22. Last 2.5 years, it has given an exceptionally good return for investors. Post-tax, post-expenses, giving around 5% alpha over the benchmark. We expect to do the same in the new series also, and I think it will be following the same style and philosophy of sector rotation.
Right, right. Well, thank you so much for coming on to our show. It was great talking to you. We heard a lot of insights. Thank you so much for your time.
Always a pleasure to interact.